Stocks, bonds, ETFs, straight out of downtown Chicago. This is Zach's Market Edge.
Welcome to Zach's Market Edge, the podcast about investing in your life. I'm your host, Tracy Reinick, and this week I'm joined by Zach's Director of ETF Research, Nina Mishra, to talk about what's going on in the ETF world here in 2022, and specifically our favorite topic, Cathie Wood at ARK Investments and her ETFs, as well as the other ETFs that are the hottest of 2022, and they're not the ARKs, obviously, but another area remains the champion again here in 2022, was the champion last year in 2021. But what's happening with these two groups is all the money flowing into the champion sector? Is it abandoning Cathie finally or not? I don't know, but I invited Nina on to talk about all this because she has all the details and all the good background on what is going on out there in ETFs. So welcome, Nina.
Thanks, Tracy. Yeah, this is a very interesting topic, and as you mentioned, if you look at the performance, oil, energy stocks, they continue to be the hottest. Energy was the best performing sector last year, and this year also it continues to do well. So this oil rally, which has been supercharged by the war, that continues. And we are talking today on May 31st, and oil is up a lot again today because China is opening up, and Europe has finally decided to, put more restrictions on Russian oil. So yes, this is a very interesting topic, and ARK, which we always talk about, that remains favorite with traders, and despite very poor performance this year, those stocks have been beaten down, those ETFs have been beaten down, but they continue to gather assets. So Cathie Wood's flagship ETF, which is the ARK Innovation Fund, ticker symbol ARKK, that has gathered over $1.6 billion in assets this year, even though it is down a lot. In fact, all her funds are down this year. The ARK Innovation Fund is down almost 52% year to date, and then followed by the Genomics Fund is also down 45%. Then FinTech Innovation Fund is down about 53%. So despite that very, very poor performance, ARK continues to gather assets, but only the flagship fund is gathering assets. The other ETFs by ARK haven't gathered assets this year.
Okay, that's interesting to know. But I'm not surprised because the flagship has always been kind of where it's at.
Right, yeah. So that flagship fund has all her strategies. So that is why in one ETF wrapper, you get all ARK ETFs. So that is why it is always popular. It is the most well-known, and that is the one which continues to gather assets.
Yeah. So, we've talked about her funds in the past and comparing them to the Janus funds, which is really the only thing we can kind of compare what she did with, these kinds of funds with the active managers. And I took a look again to kind of see what was going on with the Janus funds. When we last talked about this comparison between these two, we were looking basically at the end of 2020 when ARK had that amazing year in 2020, and Janus 20, and specifically that fund, Janus 20, had an amazing year in 1999. And then we were discussing like what happened after that. But now that we've had the pullback to some extent in what ARKK is doing, I thought I needed to look at what was happening with Janus 20 several years after that one started to pull back. And did they see a lot of money exiting? Now they couldn't have money coming in because they did close all those funds. And I didn't realize that even in 2000, when the market, peaked in March of 2000, the NASDAQ, and then started to sell off, it still saw huge inflows because of how hot 1999 was. So they did have to close 5 more funds in early 2000. So by the time 2001 came rolling around, I think they had 8 of 17 of their funds were actually closed to new money by February of 2021. So it's a little bit different because the money could not come in there like it can go into ARKK right now. But that being said, I look to see when did investors start taking the money out, because that's kind of the key indicator. Because I am surprised that the money is still going in to ARKK, at least, given the 52%, down so far just this year. And just looking around in the old archives, I found that it wasn't until the fourth quarter of 2020 or 2000 that finally the money started to come out. So they did see 2.1 billion come out of the Janus funds. That's the whole fund family by that fourth quarter. So people stuck in there for at least the first 6 months of the sell-off. Janus 20 itself was down 32% in 2000. And then it was down another, it was down another 29.2 in 2001. So that slide was a little bit longer, it took a little longer than what we're seeing ARKK doing right now. But the money kept coming out in 2001. So they had about 11 billion in outflows through November 30th in 2001, as finally investors started to just say, like, I've had enough of the pain and I'm getting out of this. But that's what makes it so interesting about what's happening with ARKK, because it had plenty of pain last year too. And now we're almost in the middle of 2022 here and down 52%. And yet there's still remaining believers in Cathie.
Yes, it is very, very surprising. So as you mentioned, they had very good performance in 2020. But now if you look at the longer term performance since inception, and ARKK, the flagship fund, the inception date was October 31st of October 2014. And if you compare the performance with the S&P 500 index and the Invesco QQQ, which is the technology focused broad index, the ARK fund has now underperformed both. Its performance is pretty close to the S&P 500, but over the long term, since its inception, it has underperformed the QQQ. And most investors, they started buying ARK after they were very hot.
Right.
So I think most of the investors who have rushed in, who have poured money in this ETF, the believers who call her Cathie Auntie or Cathie Bay, or Money Tree, they must have lost money, but they are sticking with her. And Cathie continues to double down. Some of her, like, I have a lot of respect for Cathie. She is the most well-known, one of the most successful asset managers, female asset managers in terms of asset gathering. And I like her conviction in her strategies. But some of her, statements, some of her tweets, they make me kind of scratch my head. Like, does she really believe that? Like, recently she tweeted that our research shows artificial general intelligence, AGI, that is going to transform the world. And within 6 to 12 years, breakthroughs in AGI could accelerate GDP growth from 3 to 5% per year currently to 30 to 50% per year. So just imagine GDP growth of 50% per year within the next 6 to 12 years. Is that really a possibility? I mean, we all want flying cars and robots everywhere, but we know that these changes do not happen in years. They take decades, and we have been hearing about these changes, and we know the adoption of AGI is going to accelerate, but not in 6 to 12 years, not that kind of change in 6 to 12 years. And recently at a conference, she was asked about her strategies and the poor performance, and she doubled down. She said that we have this longer term 5-year outlook, and our annualized performance may be close to 50% in the coming years. So I think some of her statements do not make much sense. So they're like, she also had predicted that oil will go down to $12 a barrel because EVs are taking off. And we also know that EVs, the takeoff is not happening very soon because those critical inputs which are required for EV batteries, the world is not suddenly going to produce because they are not, the supply is just not there. So adoption of EVs is also going to take time. And oil is, it may be, it's, she said $12 and it is above $120 as of now. So
right. Yeah, so, it's not even close.
Yeah, so some of her statements don't make any sense.
Right. But do you think that it's because of, her bullishness that's keeping people, to still dive in, to hang around, or in the face of those kinds of losses? Or do they just really think that this is a buying opportunity? Most of the losses are priced in. How much lower can it go? And I do want to own these innovative companies, so now I'm getting them on sale. Is that how they view it? I don't know.
Yeah, so that's a big possibilities. I mean, innovation, disruptive innovation that she talks about is a hot theme, and it is a sexy topic. So everyone wants to invest in disruptive innovation, the kind of artificial intelligence, EV, and everything. Other possible reason is that investors who bought ARK, maybe they used it as one of their satellite holdings, like their core holdings were in the broad indexes, SPY or QQQs, and a little allocation to ARK just for that extra sizzle in the portfolio. So it's possible that this was a smaller part of the holding, of the portfolio holding. So people are continuing to hold. And yes, Cathie being Cathie makes a lot of difference because she has such strong belief in her strategies, and because of her tweets and because of her statements, probably investors are sticking with her, and they may see a good buying opportunity at these levels. So we will see if the pain continues in these high growth stocks, which which are not, many of them are still unprofitable and will not make any money in the coming years, and they are going to be beaten down because in the rising rate environment. So it remains to be seen how long her strategies will continue to suffer, and how long investors will tolerate that poor performance. One interesting thing is that earlier, last year in particular, Tesla's excellent performance kind of provided some cushion to ARK's downslide. Now this year, Tesla has also been beaten down so much because Elon Musk's interest in Twitter and other reasons. So in fact, Tesla, for the first time, is not the top holding in ARKK. Currently, Zoom Video is the top holding in ARKK, the flagship fund.
Yeah, that tells a lot. Interestingly, when I was looking at the Janus 20 about what they did, they were heavily concentrated in these growth stocks too. So in 2000, they had 38 stocks in the Janus 20, which is a little bit under what Cathie has in the ARKK. But they were all kind of, in the similar vein, like the ones that would lead you into the next century, essentially. And by 2001, they had sold out of most of those names. So they sold out of like Juniper Networks. I don't know if you remember that one. Palm, which was the Palm Pilot. That's not even around anymore. WebMD, that was their big winner in like 1999 during the .com craze. And they finally had to get out of that. And what did they buy in 2001 to replace some of these? They bought Exxon, Eli Lilly, and Citigroup. And now those were in the top 10 holdings by the end of 2001 in this. So
that's really interesting.
Yeah. And I don't think, just based on what you were just saying about Cathie's statements, we know how she's anti-oil and that kind of energy. I don't foresee her ever going in this direction that Janus 20 ultimately had to go into in order to make some money in their funds. So that's also why I find it fascinating. And I do admire her as well as what you were saying, Nina, about her sticking with her strategy. It is her strategy. She is a growth investor. Growth is not working right now, obviously, but she's not going to change her strategy. And to me, it's no different than, Warren Buffett is a value investor. He's always been a value investor, even when it was out of favor and he was mocked and, called old man and all this other stuff numerous times in his career. But he always stayed with his strategy. You could take it or leave it as an investor. You didn't have to buy Berkshire stock if you didn't, want to be in value. And the same with Cathie and the ARKK. You don't have to own it if you don't like what she's doing with the strategy. But I do admire that she is sticking with what she wants to do and what has been her strategy since 2014. So.
Yeah, so she believes in all the disruptive innovation, digital assets. For example, she predicted that Bitcoin will go to $500,000, and then she raised it to $1 million a few months later.
Yeah.
And she continues to buy Coinbase, which has been beaten down so much because all cryptocurrencies have been beaten down. So she continues to buy those stocks, Coinbase, all digital asset related stocks, and also other stocks like Teladoc, Zoom Video, Roku, all stocks which have been beaten down. She continues to buy them. And yes, she's never going to buy oil stocks because that's not disruptive innovation. And as far as Buffett is concerned, he did not buy technology stocks for a long time, but then he started buying, like he bought Apple, which is the largest holding in terms of portfolio allocation, and he has made a lot of money on Apple too. And maybe Buffett or his lieutenants, they have bought some other technology stocks too.
They have.
So but I don't think Cathie is going to change her strategies because her theme is about disruptive innovation, and many of these companies in this space, they are loss-making companies and they will not make any money in the coming years.
Yeah, it's going to be interesting to see kind of where things go. Another thing I saw that was also kind of interesting was that in 2001, when Janus 20 was talking to the press, or just Janus in general, about what was happening with their funds and, the downturn and everything in the growth stocks, they mentioned that, they're not going to hit home runs every time with every stock that they pick. And they also mentioned we have, excellent research staff and they're digging deep on these companies. So we have a good handle on what's happening behind the scenes, with these industries and these companies. And to me, it sounded extremely similar to some of Cathie's comments recently as well, talking up her research team and, that she too isn't going to hit home runs every single time either. And they both also talked about the long-term story in these companies and how they're invested for the long term. But then Janus 20 decided to make a change after about a year of that. Year more of pain. They decided that they didn't care about the long term anymore, and they just bought Exxon. So it will be interesting to see what Cathie does. But I do think she will stick with her strategies. I mean, that this is how she operates. And again, if you don't like it, then don't invest in her funds, basically.
Yeah, true. Exactly. And she doesn't like oil. She mentioned that oil is going to $12 a barrel. But the fact is that there is not enough supply of oil in the world, and the world is just not ready for the energy transition. So that is why oil prices continue to go up. And the problem with the oil stocks and ETFs and exposure to those stocks is that most investors have these a lot of allocation in their portfolio to broader ETFs and mutual funds which track the S&P 500 index. And if you look at the allocation of S&P 500 to energy, even after last year's surge and this year's continued to surge, energy is less than 5% of the S&P 500 index. So most investors are under allocated to energy, and yes, energy is not hot. It is, people don't want to talk a lot about energy because they believe in climate change. I also believe in climate change. That is happening, but the thing is that we are not ready for the transition. So till then we will have to have fossil fuels. We will have to live with the fossil fuels, and these companies will make a lot of money because they have been pressured by the big three asset managers to not invest in drilling and instead return money to their shareholders. So they have been returning a lot of money to their shareholders in the form of dividends and share buybacks, and not investing in their operations. So that is why oil prices continue to go up and these stocks continue to be so hot.
Yeah, let's talk about that for a minute. So is there any money rotating into, the big ETF funds like the XLE, the XOP this year? Because I see, they were the hottest last year, and I see XLE's up 61% this year again, and XOP, which is the oil and gas exploration and producers ETF, that one's a little hotter, as it should be, up 66.3%. It's almost the exact mirror image of ARKK, which is, as we said, down 52. So you would think, based on momentum, and it had the great returns last year, it's having it again this year, that suddenly the money would be coming in to these types of ETFs. But is it?
No, surprisingly, it is not. So XLE, which is the biggest energy ETF, it's a broad energy ETF, market weighted, one of the cheapest one too. That has gathered just about 656 million in assets this year. The other large one, which is by Vanguard, VDE, that has lost assets, and XOP has also lost some assets, slightly, about 33 million. Wow. Even the leverage ones, which were very popular with the retail traders, Reddit forums like NRGU and Gush, they have lost assets this year. Maybe people, the traders, they were using them, and once they saw returns of these 100%, they started booking profits. So similarly, other energy ETFs too, I think people did put money last year, and this year also they put some money, but once they see those kind of returns of 20% within a month, probably they are taking some money out too. So that may be the reason why these are not gathering a lot of assets, because people may be, just booking those profits after saying, oh, my energy ETF is up like 30% in 2 months, so why not book some profits?
Right. And especially given the track record of energy over the last decade, it hasn't been a real reliable performer. You do get some of these rallies and then it gets crushed down. So why wouldn't you take some of your gains off the table when you get them, I guess?
Yeah. I mean, the oil rally has been supercharged by the war, but still it's a cyclical. Energy is cyclical. So if something happens to global growth, then obviously oil will not continue to surge like this.
Right.
And that may be the reason why people don't want to invest. And I read an article in the FT Financial Times recently that energy companies are even struggling to attract talent because younger people, they do believe in climate change, so they don't want to go work for energy companies. They want to go work for Apple or Google or even smaller technology company which may not be making money, but they don't want to go work for the likes of Exxon and Chevron, which are making a lot of money.
Right. And it could be in something just like marketing. If you're a marketing major and you're just graduating college and you think about where you might want to work, and it isn't at Exxon, even though, there's some great jobs there in marketing, I'm sure. But yeah, and then you have the other problem too of any talent coming down the pipeline on the engineering side. There is petroleum engineering is an actual major, and it used to be, pretty popular because you would go to work in these very good jobs at big oil. But now the young people are like, what's my future in that? Why would I bet my career to be a petroleum engineer? No, I'm not going to do it. And so now they're short on up and coming talent as well, because we haven't made the transition over yet. We still do need engineers, and the older ones, the experienced ones, are retiring now. So there's a talent, deficit there for even just something on the engineering side. But yeah, the industry has problems all across the board on labor, even in attracting labor to drive crude trucks or work on the rigs, all of that, because people have been laid off several times in the last decade. It is a not popular industry. There's plenty of other jobs that are open right now that also have good pay that are outside of the energy industry. So people are willing to go in those other directions, but that's also going to pressure the prices higher on energy here. So that'll be something else to watch. But yeah, I'm really intrigued that not many people are, going into this industry or even investing in it, watching it, caring about it or anything, yet we're getting these, huge outsized gains in the stocks.
Right. And something very interesting happened recently in the ETF space. And I just wanted to mention that you and I have discussed that. So this company called Strive Asset Management, they filed for 3 ETFs. And they said that instead of the stakeholder capitalism, which is being practiced by the big 3 asset managers, BlackRock, Vanguard, and State Street, these 3 asset managers, they tell companies to cut their climate emissions, improve diversity, embrace other ESG-related changes, and because of which the major oil companies have not been investing a lot in their operations, and they have been returning cash to shareholders instead. So this company, Strive, says that we will practice excellence capitalism. So we will tell Exxon and Chevron to do what you do best, drilling. Yeah. So I think it would be very interesting to see how those 3 ETFs gather assets, whether investors really want companies to do what they do best instead of embracing all ESG goals when the world is not ready for transition to energy. It will take some time.
Now, did those launch already?
No, they have been filed, so we should see the launches sometime in about 2 months.
Okay.
Yeah.
Okay. Well, that'll be definitely interesting and something to keep a watch on, and maybe we'll be chatting about that in the future. I thought for a moment there you were going to tell me that someone was filing for a new energy ETF.
No,
because we've talked about that. Nobody files for any, other than Gush or those ones, but on the stock equity side, it's still just these old ones like XLE and XOP and some of those that have been around a while. Nobody's dared to dive in on this this area. Maybe it'll be a sign. Once they do, then we'll know we're towards the end of this rally. Maybe once they start to dive in.
Yeah, so if you look at this year's ETF launches, there are a number of thematic ETF launches, a number of ESG-related launches, and in all sorts of flavors, which say socially responsible, clean, green, or whatever. And some themes like the metaverse is very hot. Themes like digital currency, blockchain-related ETFs, they're very hot in terms of launches, not in terms of performance. So we continue to see those ETFs, products based on those hot themes, continue to launch, and they continue to gather some assets too, even though the performance continue to suffer. But no, we don't see any energy ETFs, the plain vanilla energy ETFs launches in the past few months.
Yeah, interesting. For people who are wondering if they do want to invest in some of these energy ETFs, the 2 that we mentioned, the XLE and the XOP, The differences between the two, the XLE covers the entire sector. And the two biggest holdings are Exxon and Chevron in that one, and they make up 43.7% of that ETF. So if you want to own Exxon and Chevron and you don't want to own just the individual stocks, then XLE is for you. The XOP is more evenly invested across, so you don't have the concentration in like two big oil companies. And Exxon is on the top 10, but that's because they're all about 2 to 3% of that fund. So you're going to get only the explorers in that one, but that does include like Exxon, Occidental, Diamondback, Calon Petroleum is the biggest position at 3%, ticker CPE on that one. But if you go in there, you'll see right away the differences. XLE, because it's the entire industry, will also own the services side, like Schlumberger, Halliburton, those types of companies will be in the XLE as well, just so people know the difference. And then I do get questions like, which one do you like better, Tracy? I'm a big fan of the explorers here, because that goes directly to the price of crude and natural gas. That goes to their earnings, and both of those are at 10-year highs. So I'm just going to go right to the guys who are getting it out of the ground. But the other side, the services side, the refining, service stations, all of that will still also do well, and they're going to benefit as well. But it's not as much of a pure play, and it also works on the flip side. So once we do have a pullback in crude, say we do get some kind of ceasefire or end to the Ukraine war, likely crude prices will drop. And when that happens, those stocks tend to get beaten up a lot more than, say, on the service side. So keep that in mind. It's going to be more volatile to own the explorers. There's a lot of glory on the way up, but a lot of pain on the way down. If we get a big pullback in energy, then you will see those stocks really pull back as well. So keep that in mind. Any other advice for people looking to get into energy, Nina?
Yes, so I own both XLE and XOP in the ETF investor portfolio, and I totally agree with what you said about these two ETFs. There are a couple more ETFs if you want more exposure to smaller energy companies. Probably you could look at BSCE, which invests in S&P, in the energy stocks, small cap energy stocks from the S&P 500. The ticker symbol is BSCE, and there's one equal weighted ETF, which is also by Invesco, RYE. So these both these ETFs will provide exposure to smaller energy companies. So these two have done very well this year. And just a small correction, BSCE tracks energy stocks from the S&P small cap 600 index, not the S&P 500. So these, but again, as you mentioned, these smaller companies, they may continue to do very well. They may continue to outperform the bigger ones, the larger ones, when oil prices are going up. But if oil prices come down because of a resolution to war or whatever reasons that you mentioned, these may underperform. But I think for longer term investors, XLE or VDE, which is very similar to XLE, or XOP, those are the ETFs which investors could hold in their portfolios for the longer term, because they're broader ETFs like SPY or VOO, they don't have much exposure to energy.
Yeah, what kind of return does that small cap one have? The BSCE, is that what it is? BSCE?
So BSCE is up about 65% year to date.
Wow.
And the equal weight, that is also up about 64%. So very, very attractive performance, but they are going to be much, much more volatile than the likes of XLE, which is market cap weighted, which you mentioned that a lot of exposure to Chevron and Exxon.
Okay, so that's a lot of discussion today.
Yes, Cathie versus oil is
the hottest.
Yes.
Yeah, we've covered the hottest and the worst. Mm-hmm. We've covered both ends. So, yeah, this is always good. It's good to get a perspective on what's going on out there and, you know, to see what's happening with where the money is going and where it's not. But that doesn't always mean what the performance is doing. But eventually the money starts going where the performance is. So that's why I'll be interested to see what happens with some of these energy ETFs as the year continues to go on. And even ARKK, and if they can continue to take in money, but we will see.
I wanted to quickly mention that there was last year this ETF which shorts ARK, SARK, that launched last year. So that saw some interest from investors. It gathered more than 400 million in assets, and this has surged almost 75% year to date. So that same firm also launched 2X ARK ETF. The ticker symbol is TARK. So if you want a short, you have the choice of SARK, SARK. But if you want to double ARK's returns, negative or positive, then you have TARK. But TARK has not seen much interest from investors so far, though it is very new too. But for investors, too risky. Both are too risky. But for investors, yes, you want to short ARK, there is an ETF available. And if you want to double ARK, there's an ETF for that too.
Right. So that's a good point, because that's a way to, if you really believe that Cathie is in the wrong here and you're not an investor in her portfolio, but you want to bet against her, well, now you have two ways to do it. So go for it. But I wouldn't bet against her. I'd be scared.
No, me neither. I've never bought her ETFs, and I've never bet against them. So because you never know, she may be successful in 5 years or fail totally, may wind up her firm. We will see.
Yes, we will. Okay, let's recap some of the tickers, what we talked about. So there was ARKK, ARKK, that's the flagship fund. We also mentioned the ARK Genomics, which is ARKG. There's we mentioned a couple stocks, so let's talk about those. It also in her funds, Tesla, of course, TSLA, Zoom, ZM. We did mention Apple in Buffett when we were talking about him, AAPL, obviously. Exxon, we've mentioned them a couple times. XOM, we mentioned Chevron. CVX is the ticker there. I mentioned Calon Petroleum. CPE is the ticker. And then the ETFs on energy side, XLE, XOP, BSCE, that RYE, those are the small caps, RYE. And then if you want to short Cathie, SARK and TARK are the two. That's the double one to short them. But there's a lot going on the world of ETFs, and it's another interesting year. So I'm sure I'll have Nina back on later on in the year.
So just to clarify, the other TARK is 2x. It's not minus 2x. SARK is minus 1x. And if you really believe, if you really believe in Cathie and her strategy, and if you believe that this is the time to buy those beaten down strategies, then you buy the TARK ETF.
Yes,
but very risky.
I was confused myself there. I was thinking it was double the short. That would be even more fun. But no, it makes sense that not much money has gone in there then, because they're scared to do the positive, the double the positive side. But usually, it's dark before the dawn, right? So
yes, true.
I will keep an eye on that to see if money starts rotating back in there as kind of like a sign that maybe we've seen the bottom or close to it in some of these growth stocks. So okay. Yes, that's good to know. Keep that in mind. It is 2 times, not the minus 2 times on TARK, TARK. We don't want to send people down the wrong path on that one for sure. Okay, so be sure to subscribe to get all of our podcasts here. You can get us on Apple Podcasts, and you can also get us on SoundCloud. You're going to get the Value Investor Podcast on SoundCloud as well. Spotify, you can get us anywhere the podcast platform is out there. We're on most of them, but be sure to get us somewhere, because next week I'll be here again with some more stocks.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.